Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Verizon stock is still down over the past year, but shares have recovered about 20% since hitting their lows a month or two ago. And one of the biggest reasons for that is the company's operations are really starting to turn around. The investments that Verizon has made in 5G and building out the broadband business that's built on top of 5G, fixed wireless is what they're calling that, is really starting to generate new business and cash flow. And as that cash flow increases, their cash expenditures are starting to decrease. So I think this is one of the best buys in the market right now. As I'm recording, the dividend yield is 7.3%, just a phenomenal payout for such a solid business. So I want to get into what I like about Verizon right now in this video. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. Now, I want to just start with a high level look at Verizon's financials because this tells the story of where the company has come from. This is a look at cash flows, and you can see that cash from operations is up slightly from a year ago. This is the 9 months ended at the end of September 2023. So not a big increase in cash flow, but definitely heading in the right direction. The difference is that capital expenditures are starting to come down. If you break this down by quarter, capital expenditures are coming down each quarter in 2023 as cash from operations actually goes up. What you have then is a sharp increase in free cash flow. I'll show a chart of that in just a second. But you can see that free cash flow is up $2.2 billion just based on these numbers in the first 9 months. And like I said, the acceleration of that is actually picking up right now. Total debt, it's either flat or coming down depending on which quarter you look at, but they're starting to improve their debt situation. This is something I'd like them to be a little bit more aggressive about. But you can see that we do have a reduction of about $7 billion in net unsecured debt. That's partly because there's more cash on the balance sheet. Over time, Verizon will likely use some of that cash to pay down debt. And the net unsecured debt to adjusted EBITDA, which is a measure of leverage for the business or risk, if you want to look at it that way, is 2.6. So the trends are heading in the right direction. And this is the chart that I was talking about just a second ago. You can see that over the past year, free cash flow has gone from under $2 billion per quarter to now $6.7 billion in the most recent quarter. Cash from operations is also up, not quite as dramatic of an increase, but the free cash flow includes not only the increase in cash from operations, but also the reduction in capital expenditures. So really two things that are working in tandem there. So what is going right at Verizon right now? Well, part of it is this is the payoff from years of investment in both buying spectrum and then also building out the 5G network. This is the challenge for telecommunications companies is you spend tens of billions, if not hundreds of billions of dollars building out the network, and then it takes years to recoup that investment. So we are through the vast majority of the investment phase for 5G, and now we're at the point where they're recouping that investment. So what you would expect to see is debt is going to be at its highest at the end of that investment phase. So a couple of quarters ago would probably be about the time you would hope that debt would be at its highest and cash flow would be at its worst. Over time, and not just on a quarter over quarter basis in 2023, but even out 4, 5, 6, even 10 years, we should see cash flow from that investment start to improve. So we're starting to see the initial phases of that. That's part of what the market is reacting to. But I think we're going to see that growth continue. And some of the metrics really tell the story here. Now, the headline numbers aren't all that impressive for Verizon. You can see that revenue is down 2.6% year over year to $33 billion. But there are a few components to revenue that we need to pull out. One is wireless equipment, and then they break it out in red here is service and other. So wireless equipment is things like when you buy a new phone at a Verizon store. Typically, Verizon is going to give a subsidy on that phone. So the wireless equipment business is often a loss leader. The more revenue grows in wireless equipment, the more losses there are on sales from wireless equipment. So what you would actually like to see is fewer sales for wireless equipment. And that's exactly what we're seeing here. The reduction year over year is about $900 million. but $700 million of that reduction comes from a decline in wireless equipment sales. So revenue is down. That sounds bad, but it's good that wireless equipment revenue is down. So a little bit counterintuitive there. The services and other business is broken into a couple of different segments. This includes things like broadband and cable services. But the big one that we want to keep an eye on, and this is going to be related to 5G, is the total wireless service revenue. This is going to be everything from reselling through Comcast and Charter to the monthly bills that people pay to fixed wireless access that people are adding. So that revenue source is up $500 million or 2.9% in the past year. This is going to be a very high margin source of revenue. Unlike equipment, which is a negative margin, this is going to be a margin that's more like a software margin. 60, 70, 80% is what you're typically going to get from this total wireless service revenue. So any growth in that side of the business is going to be positive. And this is what brings me back to the 2 points of strength that we have from an operating perspective from Verizon. One is the broadband net adds, and this is in thousands of customers. There's a few additions on the wireline. So that would be DSL and fiber, 50,000 in the most recent quarter. That's an okay number. But you go to this gray bar, and this is fixed wireless, 384,000 additions in just the last quarter. They're discounting this pretty significantly. I think you could start with fixed wireless at around $25 per month. But management said in the most recent conference call that they're actually going to be increasing those prices over time. And you can see that this is now a really big business, adding around 1.5 million customers per year just with fixed wireless. So if that goes from a $25 a month fee to $30, $40, $50, you can see incremental growth there. Verizon's also adding a lot of business retail postpaid phone additions. Again, over 100,000 additions there in each of the last 5 quarters. So strength there, offsetting some of the weakness that they've had in the consumer business. So in a lot of respects, Verizon is entering a phase where we should be seeing operating cash flow and free cash flow grow as the company monetizes this business that they've been investing in for years. So investors are worried about a number of things. One, the scale of the investment that they've had to make in 5G and all the debt that they've had to take out. But it looks like a lot of that's behind us. They're also worried about refinancing that debt. Are they going to be able to do that at a in a cost-effective way? Well, one of the things that Verizon can do is pay down debt with the extra free cash flow that they've had. They've started to do that. Like I said, I would like to see them be more aggressive doing that. And given the sheer scale of Verizon's debt, it is important to reduce debt, to reduce the cash that's just being used to pay interest. But I think they can do that with the growing cash flow, and the valuation is just too strong to ignore. Like I said, dividend yield 7.4%. As I'm recording, the enterprise value to EBITDA, which is a proxy for cash flow on a trailing 12-month basis, so that means looking backwards, is 6.1. On a forward-looking basis is 6.8. So under 7, no matter how you're looking at it. I think that's a pretty solid valuation for a company that is in an oligopoly in the US. There's only 3 major suppliers of wireless services. It seems like the competition between those companies is starting to come down. And one thing I haven't mentioned yet is the growth opportunity that we have for Verizon in bundling services. We're starting to see them sell more streaming subscriptions that make sense to bundle with not only your cell phone wireless subscription, but also your fixed wireless. And now we've got a few million customers that they can bundle those 3 products together. So potentially another piece of incremental margin they can add to the business. So I really like where Verizon is sitting right now. Just a phenomenal value. The stock's not going to skyrocket. This is not a tech stock. It's not a high growth company, but it is a steady as you go company. And given the high dividend yield, I think there's a lot to like for investors, especially if your focus is on dividends. So what do you think about the results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.